In today's dynamic financial world, the quest for financial security and growth has led many individuals down the exciting, yet often daunting, path of investment. Gone are the days when investment was a realm reserved solely for Wall Street moguls and financial experts. The rise of technology, coupled with increased accessibility to financial markets, has ushered in a new era of investors, eager to take control of their financial futures. This surge in interest, however, is met with a crucial question: where to invest? Traditional investment avenues like bonds and real estate remain popular, but two contenders have emerged as front-runners in capturing the imagination of both seasoned and novice investors: stocks and cryptocurrencies. The allure of these investment vehicles is undeniable. Stocks, representing ownership in established companies, offer a sense of familiarity and a historical track record that many find reassuring. Cryptocurrencies, on the other hand, burst onto the scene as a revolutionary force, promising decentralized financial systems and the potential for outsized returns. This juxtaposition of the familiar and the novel has created a buzz within the investment community, drawing in individuals from all walks of life, each with their own financial goals and risk tolerance. But as with any investment decision, understanding the intricacies of both stocks and cryptocurrencies is paramount. Stocks, often considered the cornerstone of a well-diversified portfolio, offer investors a piece of ownership in publicly traded companies. From tech giants like Apple and Amazon to industrial powerhouses like Boeing and General Electric, the stock market provides a vast landscape of investment opportunities. The appeal of stocks lies in their potential for long-term growth. As companies expand their operations, innovate, and increase their profitability, the value of their stock typically appreciates, rewarding investors who have bought into their success. Furthermore, many companies distribute a portion of their profits to shareholders in the form of dividends, providing a steady stream of passive income. Cryptocurrencies, on the other hand, present a starkly different investment proposition. Operating on decentralized digital ledgers known as blockchains, cryptocurrencies like Bitcoin and Ethereum have captured the imagination of investors seeking high-growth potential and a departure from traditional financial systems. The allure of cryptocurrencies stems from their decentralized nature, their potential to disrupt existing financial paradigms, and their track record of significant price appreciation. Stories of early Bitcoin adopters turning modest investments into life-changing wealth have fueled the frenzy surrounding cryptocurrencies, attracting both risk-averse and risk-seeking investors alike. While the potential rewards of investing in stocks and cryptocurrencies are undeniable, it's crucial for investors, especially beginners, to approach these markets with a healthy dose of caution. Both asset classes come with inherent risks that can lead to significant losses if not properly understood. The stock market, while generally considered more stable than the cryptocurrency market, is not immune to volatility. Economic downturns, geopolitical events, and company-specific news can send stock prices tumbling, impacting even the most well-established companies. Investors must be prepared for the possibility of short-term fluctuations in their portfolio value and avoid making impulsive decisions based on fear or panic. Cryptocurrencies, known for their extreme volatility, present a different set of risks. The value of cryptocurrencies can fluctuate wildly in short periods, driven by factors such as regulatory news, technological advancements, and market sentiment. This volatility makes cryptocurrencies a high-risk, high-reward investment proposition, best suited for investors with a high-risk tolerance and a long-term investment horizon. Navigating the complex world of stocks and cryptocurrencies requires careful research, a sound understanding of market dynamics, and a clearly defined investment strategy. Beginners are advised to start small, diversify their investments, and seek guidance from experienced financial advisors. Remember, investment is a marathon, not a sprint, and patience, coupled with informed decision-making, is key to achieving long-term financial success. Imagine a bustling marketplace, not one filled with vendors hawking fruits and vegetables, but rather one where companies, big and small, offer pieces of themselves to the public. This, in essence, is the stock market, a dynamic arena where businesses raise capital and investors seek to grow their wealth. At its core, the stock market operates on a simple principle: supply and demand. Companies, seeking to fund expansion projects, develop new products, or simply bolster their financial standing, issue shares of stock, representing fractional ownership in their businesses. Investors, eager to participate in the potential growth and profitability of these companies, purchase these shares, becoming part owners in the process. This exchange of ownership, facilitated by stock exchanges like the New York Stock Exchange and the Nasdaq, is the lifeblood of the stock market. As companies thrive and their prospects brighten, demand for their stock increases, driving up prices. Conversely, negative news, economic downturns, or simply changing investor sentiment can lead to a decline in stock prices. Understanding the dynamics of the stock market, while seemingly complex at first glance, is essential for anyone seeking to invest their hard-earned money. It's a world where knowledge is power, and informed investors, armed with a solid understanding of market mechanics, are better positioned to navigate its complexities and capitalize on its potential rewards. Section 2. Stocks, building blocks of ownership. When you buy a stock, you're not simply purchasing a piece of paper or a digital entry in your brokerage account, you're acquiring a tangible stake in a company's future. Each share of stock represents a unit of ownership, granting you, the shareholder, certain rights and privileges. The extent of these rights varies depending on the type of stock purchased, but common stock, the most prevalent type, typically grants shareholders voting rights on company matters, such as the election of board members or major corporate decisions. While the weight of an individual investor's vote is often minuscule, particularly in large, publicly traded companies, the collective voice of shareholders can influence a company's direction. Owning stock also entitles you to a share of the company's profits, should they choose to distribute them to shareholders in the form of dividends. These periodic payments, typically issued quarterly, can provide investors with a steady stream of passive income, further enhancing the appeal of stock ownership. However, it's crucial to remember that stock ownership is not without its risks. As a shareholder, you're exposed to the company's financial performance. If the company struggles, its stock price may decline, resulting in a loss for investors. Conversely, if the company excels, its stock price is likely to rise, rewarding shareholders with capital appreciation. This inherent link between a company's performance and its stock price underscores the importance of thorough research and due diligence before investing. Section 3. Public versus private, two sides of the same coin. The world of stocks encompasses two distinct spheres: public companies and private companies. While both involve the issuance of stock to raise capital, the process and implications for investors differ significantly. Public companies, as their name suggests, offer their shares to the public through initial public offerings, or IPOs. This process, strictly regulated by the Securities and Exchange Commission, allows companies to raise substantial capital by selling ownership stakes to a wide range of investors, from institutional giants to individual retail investors. Once a company goes public, its shares are traded on stock exchanges where their prices fluctuate based on supply and demand. This liquidity, the ease with which shares can be bought and sold, is a major advantage for public company investors, as it allows them to enter and exit positions relatively easily. Private companies, on the other hand, operate in a more exclusive realm. They raise capital by selling shares privately to a select group of investors, typically venture capitalists, angel investors, or high-net-worth individuals. These shares are not traded on public exchanges, making them less liquid but also potentially more lucrative if the company succeeds. However, investing in private companies comes with higher risks and requires a longer investment horizon, as exit opportunities are limited. Section 4. Navigating the stock exchange. Imagine a vast digital auction house where millions of shares change hands every second, their prices fluctuating in real time, driven by a complex interplay of algorithms, news events, and investor sentiment. This is the stock exchange, the central nervous system of the stock market. Stock exchanges like the NYSE and the Nasdaq serve as regulated marketplaces where buyers and sellers converge to trade stocks. Gone are the days of chaotic trading floors filled with shouting brokers. Today's exchanges operate electronically, connecting investors from around the globe through sophisticated trading platforms. Each stock exchange has its own listing requirements, which companies must meet to have their shares traded. The NYSE, known for its blue-chip companies and traditional auction system, sets a high bar for listing, while the Nasdaq, home to numerous technology companies, has more flexible requirements. Understanding the role of stock exchanges is essential for investors, as it provides insights into market dynamics, trading volumes, and the overall health of the stock market. By tracking exchange data, investors can gain valuable perspectives on market trends, identify potential investment opportunities, and make more informed decisions. In the fast-paced world of stock trading, where milliseconds can mean the difference between a profit and a loss, having a trusted intermediary to execute your trades is paramount. This is where stockbrokers enter the picture, acting as your agents in the stock market. Stockbrokers, licensed professionals regulated by the Financial Industry Regulatory Authority, or FINRA, bridge the gap between individual investors and the stock exchanges. They provide access to trading platforms, facilitate the buying and selling of stocks, and offer a range of other services such as research reports, investment advice, and portfolio management. The advent of online brokerages has revolutionized the way investors interact with the stock market. Platforms like Fidelity, Schwab, and Robinhood offer commission-free trading, intuitive interfaces, and a wealth of educational resources, empowering investors to take control of their investments. However, the ease of online trading should not overshadow the importance of choosing a reputable stockbroker. Factors to consider include trading fees, account minimums, research tools, customer support, and most importantly, regulatory compliance. Remember, your stockbroker is your trusted partner in the stock market, so choose wisely. The stock ticker, that mesmerizing stream of letters and numbers scrolling across your screen, can seem like a cryptic code, its meaning elusive to the untrained eye. However, understanding how stock prices are determined is crucial for investors seeking to decipher the language of the market. At its core, the price of a stock is a reflection of its perceived value, a constantly shifting equilibrium point between buyers and sellers. When demand for a stock exceeds supply, its price rises, and when supply outweighs demand, its price falls. Numerous factors influence stock prices, from macroeconomic trends and interest rate movements to company-specific news, earnings reports, and industry developments. Investors use various valuation metrics such as price-to-earnings ratios and dividend yields to assess the relative attractiveness of stocks, comparing them to their peers and historical performance. It's essential to remember that stock prices are inherently volatile, subject to sudden swings driven by news events, market sentiment, and even speculation. Short-term price fluctuations are common, and investors should avoid making impulsive decisions based solely on daily price movements. A long-term perspective, coupled with a sound understanding of valuation principles, is key to navigating the ebb and flow of the stock market. Imagine receiving a thank you note from a company you've invested in, not in the form of words, but in the form of cold, hard cash. That's the essence of dividends, a portion of a company's profits distributed to shareholders as a reward for their investment. Dividends, typically paid out quarterly, represent a tangible return on your investment, providing a stream of passive income that can be reinvested to purchase more shares or used to supplement other income sources. Companies are under no obligation to pay dividends, but those with a history of consistent dividend payments are often viewed favorably by investors seeking income-generating investments. Dividend payments are not created equal. Companies determine their dividend policies based on their financial performance, growth prospects, and capital allocation strategies. Some companies prioritize dividend growth, consistently increasing their payouts over time, while others maintain stable dividends, providing a predictable income stream. Dividend-paying stocks can be an attractive option for investors seeking both income and potential capital appreciation. However, it's crucial to remember that dividends are not guaranteed and can be reduced or eliminated if a company faces financial challenges. As with any investment decision, thorough research and a focus on companies with strong financial fundamentals are paramount. Entering the cryptosphere. Stepping into the world of cryptocurrencies can feel like entering a foreign land, with its own language, customs, and even its own set of passionate evangelists. It's a realm where traditional financial rules often seem to bend or break, replaced by a decentralized, digital-first ethos that has captivated millions worldwide. Cryptocurrencies, at their core, are digital forms of money, designed to facilitate secure, transparent transactions without the need for intermediaries like banks or governments. They exist solely in the digital realm, their value determined by the forces of supply and demand within the cryptocurrency market. This departure from traditional financial systems is at the heart of the cryptocurrency movement. Proponents envision a future where financial power is distributed more equitably, where transactions are faster, cheaper, and more accessible to all, regardless of geographical location or socioeconomic status. However, the path to this decentralized future is not without its challenges. The cryptocurrency market, while maturing, is still in its relative infancy, characterized by volatility, regulatory uncertainty, and the ever-present risk of scams and fraudulent schemes. Navigating this landscape requires a discerning eye, a willingness to embrace new technologies, and a healthy dose of skepticism. Deciphering digital gold, Bitcoin and beyond. In the annals of cryptocurrency history, Bitcoin reigns supreme as the original and most well-known digital currency. Created in 2008 by the pseudonymous Satoshi Nakamoto, Bitcoin emerged from the ashes of the global financial crisis, offering a radical alternative to centralized financial systems. Bitcoin, often referred to as digital gold, shares several characteristics with its precious metal counterpart. It's scarce, with a finite supply capped at 21 million coins, ensuring its value cannot be diluted through inflation. It's durable, existing as lines of code on a decentralized network, immune to physical degradation. And it's divisible, allowing for microtransactions and fractional ownership. While Bitcoin paved the way, it was not long before other cryptocurrencies known as altcoins emerged, each with its own unique features and value propositions. Ethereum, the second largest cryptocurrency by market capitalization, introduced smart contracts, self-executing agreements that automate transactions and enable the creation of decentralized applications. From stablecoins pegged to fiat currencies to privacy coins designed to obscure transaction details, the cryptocurrency landscape has evolved into a diverse ecosystem of digital assets, each catering to specific needs and investment strategies. Understanding the nuances of these different cryptocurrencies is crucial for investors seeking to diversify their portfolios and capitalize on the potential of the crypto market. The backbone of trust blockchain technology. Imagine a digital ledger distributed across a vast network, recording every transaction securely and transparently. This is blockchain technology, the innovation underpinning cryptocurrencies. A blockchain is a chain of blocks, each containing multiple transactions, linked chronologically and cryptographically secured. Its decentralized nature ensures transparency, reduces single points of failure, and empowers users. Section 4. Mining for value, securing the network. Cryptocurrency mining involves powerful computers solving complex problems to validate transactions. Miners act as auditors, verifying transactions and adding them to the blockchain. The first miner to solve the puzzle receives a reward, encouraging participation and ensuring network security. The energy-intensive nature of proof-of-work mining has led to the development of alternative mechanisms like proof-of-stake. Section 5. Beyond Bitcoin, exploring the altcoin universe. The crypto market has evolved into a diverse ecosystem with thousands of altcoins. Altcoins like Litecoin and Bitcoin Cash offer faster transaction speeds or lower fees. Others like Ethereum and Cardano introduce smart contracts and decentralized applications. Thorough research and a focus on projects with strong fundamentals are essential for navigating this landscape. Section 6. Decentralized Finance, DeFi, reshaping the financial landscape. DeFi platforms offer financial services like lending, borrowing, and trading without intermediaries. This peer-to-peer approach reduces fees and increases efficiency. Yield farming allows users to earn interest by providing liquidity to DeFi protocols. Despite risks, DeFi has the potential to disrupt traditional finance by offering more accessible and transparent services. Establishing ownership and scarcity in digital content is a challenge. Enter non-fungible tokens, NFTs, allowing for the creation and ownership of unique digital assets. NFTs represent ownership of specific assets like digital art or virtual real estate. They create new opportunities for artists and collectors to monetize digital creations. However, concerns about environmental impact and speculative bubbles remain. Fasten your seatbelts. Cryptocurrencies are known for their dramatic price fluctuations. Crypto prices can change significantly within hours, driven by speculation and market hype. Stocks, in contrast, are relatively stable, especially those of well-established companies. This stability is rooted in tangible assets and regulatory oversight. Regulation provides transparency and investor protection but can stifle innovation. The stock market operates within a well-defined regulatory framework. The cryptocurrency market, often described as the Wild West, lacks comprehensive regulation. This absence has fostered innovation but also created an environment ripe for scams and fraud. The cryptocurrency market never sleeps, allowing for round-the-clock trading. This creates opportunities and challenges demanding constant vigilance from investors. The stock market operates within traditional trading hours, providing predictability. However, it limits the ability to react to news events outside these hours. Cryptocurrencies have emerged as a disruptive force, breaking down barriers. Opening a crypto trading account is simple and accessible from anywhere. This ease of access is a game changer, especially for underserved communities. The stock market, while increasingly accessible, still requires navigating a more traditional onboarding process. Stocks represent ownership in tangible assets, giving them intrinsic value. Cryptocurrencies derive their value from digital scarcity and decentralized consensus. This reliance on digital scarcity has led to both praise and criticism. Proponents argue it frees cryptocurrencies from inflationary pressures, while critics contend it makes them susceptible to speculative bubbles. Higher risks often come with the potential for higher rewards. Cryptocurrencies are considered high-risk investments due to their volatility. Stocks, particularly those of well-established companies, are generally viewed as lower risk. This lower risk profile often comes with more moderate returns compared to the potential windfalls of the crypto market. Understanding the long-term outlook for cryptocurrencies and stocks is crucial. Cryptocurrencies represent a bold experiment in the future of money and value exchange. The stock market has weathered many storms, showcasing its resilience. The future of finance will likely be shaped by both the innovation of cryptocurrencies and the resilience of the stock market. Section 1. Stocks. Weighing the advantages and drawbacks. Stocks offer the potential for long-term growth and regulatory oversight. However, they are not without drawbacks, including market volatility and company-specific risks. Understanding the pros and cons of stock investments is essential for any investor. This knowledge empowers individuals to make informed decisions aligned with their risk tolerance and financial objectives. Section 2. The allure of stocks, stability, dividends, and historical growth. The allure of stocks for many investors lies in their potential to generate long-term wealth, often outpacing inflation and providing a hedge against the eroding purchasing power of fiat currencies. This potential for growth is rooted in the fundamental nature of stocks as ownership stakes in companies, allowing investors to participate in the success and profitability of these businesses. Unlike speculative assets, whose value is often driven by sentiment or market hype, stocks are backed by tangible assets, established business models, and the potential for future earnings. This connection to the real economy provides a degree of stability and predictability that can be reassuring for investors, particularly those seeking to preserve capital and generate long-term wealth. Furthermore, many companies distribute a portion of their profits to shareholders in the form of dividends, providing a steady stream of passive income that can be reinvested to purchase more shares or used to supplement other income sources. Dividends can be particularly attractive for income-oriented investors, such as retirees, who seek to generate a consistent cash flow from their investments. Historically, the stock market has demonstrated an upward trajectory over the long term, weathering economic downturns, geopolitical events, and periods of market volatility. While past performance is not necessarily indicative of future results, this historical track record provides a degree of confidence for investors seeking to build wealth over time. Section 3. The flip side of stocks: slow growth, regulatory hurdles, and missed opportunities. While the potential rewards of stock investing are undeniable, it's crucial to acknowledge the inherent drawbacks and potential downsides that come with this asset class. Investing in stocks is not a guaranteed path to riches, and understanding these limitations is essential for making informed investment decisions. One of the primary criticisms leveled at stocks is their relatively slow growth potential, particularly when compared to more speculative assets like cryptocurrencies or growth stocks. While stocks have historically outpaced inflation over the long term, their returns can often pale in comparison to the explosive gains witnessed in other asset classes, at least in the short term. Furthermore, the stock market is subject to a complex web of regulations and reporting requirements designed to protect investors and ensure market integrity. While these regulations serve an important purpose, they can also create bureaucratic hurdles, increase costs for companies, and potentially stifle innovation. Additionally, investors who focus solely on stocks may miss out on opportunities in other asset classes, such as real estate, bonds, or commodities, which may offer diversification benefits or higher returns during certain market cycles. Section 4. Cryptocurrencies: navigating the potential and the pitfalls. The emergence of cryptocurrencies has sent shockwaves through the financial world, challenging traditional notions of money, value, and the very nature of investment. Hailed by some as the future of finance and dismissed by others as a speculative bubble, cryptocurrencies occupy a unique and often polarizing position within the investment landscape. Their decentralized nature, their potential to disrupt existing financial systems, and their track record of significant price appreciation have captivated the imaginations of investors worldwide, attracting both seasoned traders and curious newcomers alike. However, the cryptocurrency market is not for the faint of heart. Its extreme volatility, its susceptibility to market manipulation, and the lack of comprehensive regulation create a high-risk, high-reward environment that demands a cautious approach and a thorough understanding of the underlying technology and market dynamics. Navigating the world of cryptocurrencies requires a discerning eye, a willingness to embrace new technologies, and a healthy dose of skepticism. It's a realm where fortunes can be made and lost in the blink of an eye, and where understanding both the potential and the pitfalls is paramount for making informed investment decisions. Section 5. The upside of crypto: explosive growth, technological innovation, and accessibility. The allure of cryptocurrencies for many investors lies in their potential for explosive growth, often dwarfing the returns witnessed in traditional asset classes like stocks or bonds. Stories of early Bitcoin adopters turning modest investments into life-changing wealth have fueled the frenzy surrounding cryptocurrencies, attracting those seeking to capitalize on the potential of this emerging asset class. This growth potential is driven by a confluence of factors, including the increasing adoption of cryptocurrencies as a payment method, the growing interest from institutional investors, and the limited supply of certain cryptocurrencies, such as Bitcoin, which is capped at 21 million coins. Beyond their potential for price appreciation, cryptocurrencies also represent a hotbed of technological innovation, with blockchain technology, the foundation of cryptocurrencies, poised to disrupt various industries beyond finance. From supply chain management and healthcare records to digital identity verification and online voting, blockchain technology has the potential to revolutionize the way we interact with data and conduct transactions. Furthermore, cryptocurrencies offer a level of accessibility that is often lacking in traditional financial markets. Opening a crypto trading account is typically a quick and straightforward process, requiring minimal paperwork and often no minimum investment amounts. This ease of access has been particularly empowering for individuals in developing countries or underserved communities who may lack access to traditional banking services or investment opportunities. Section 6. The crypto conundrum, volatility, regulatory uncertainty, and security risks. While the potential rewards of cryptocurrencies are undeniable, it's crucial to approach this investment class with a healthy dose of caution. The crypto market, while maturing, is still in its relative infancy, characterized by volatility, regulatory uncertainty, and the ever-present risk of scams and fraudulent schemes. Cryptocurrency prices are notorious for their dramatic fluctuations, often experiencing double-digit percentage swings in a single day, sometimes even within hours. This volatility stems from the relatively small size of the crypto market, its sensitivity to news and social media hype, and the fact that its value is largely driven by speculation rather than tangible assets. Adding to the uncertainty is the lack of comprehensive regulation surrounding cryptocurrencies. While some countries have begun to establish regulatory frameworks for cryptocurrencies, the industry remains largely unregulated, creating an environment ripe for scams, fraud, and market manipulation. Furthermore, the decentralized nature of cryptocurrencies, while one of their strengths, also creates security risks. Cryptocurrency exchanges and wallets, while generally secure, are not immune to hacking attempts, and the loss or theft of private keys, which are essential for accessing cryptocurrency holdings, can result in the irreversible loss of funds. Section 7. Finding your balance. A tailored approach to investment decisions. In the world of investment, there is no one-size-fits-all approach. The ideal investment strategy for one individual may be entirely unsuitable for another, and the decision of whether to invest in stocks, cryptocurrencies, or a combination of both depends on a multitude of factors. Factors to consider include your risk tolerance, your investment goals, your time horizon, and your overall financial situation. Individuals with a high risk tolerance and a long-term investment horizon may be comfortable allocating a portion of their portfolio to cryptocurrencies, seeking to capitalize on their potential for explosive growth. Those seeking more stability and predictable returns may prefer to focus on stocks, particularly those of well-established companies with a history of dividend payments. Diversification, the practice of spreading your investments across different asset classes, is often touted as a key principle of sound investment management. By diversifying your portfolio, you can potentially reduce your overall risk exposure and enhance your potential for returns. Remember, investment is a marathon, not a sprint, and patience, coupled with informed decision-making, is key to achieving long-term financial success. Strategic approaches, navigating the investment landscape. Embarking on the journey of investment is akin to setting sail on a vast ocean, with its own currents, tides, and occasional storms. While the allure of discovering hidden treasures and reaching distant shores is enticing, a successful voyage requires careful planning, a reliable compass, and a willingness to adapt to changing conditions. In the world of investment, this translates to developing a sound investment strategy, one that aligns with your financial goals, risk tolerance, and time horizon. Just as a seasoned captain wouldn't set sail without a charted course, a prudent investor should never venture into the markets without a clear understanding of their investment objectives and a well-defined plan to achieve them. Whether your goal is to save for retirement, purchase a home, fund your child's education, or simply grow your wealth over time, your investment strategy will serve as your roadmap, guiding your decisions and helping you navigate the inevitable market fluctuations along the way. A well-crafted investment strategy takes into account your financial situation, your investment timeline, your risk appetite, and your overall financial goals. It serves as a dynamic framework, adapting to your changing needs and market conditions, ensuring that your investments remain aligned with your long-term objectives. Dollar cost averaging, riding out the waves of volatility. The financial markets, with their constant ebb and flow, can resemble a turbulent sea, prone to sudden squalls and unpredictable waves. For investors, particularly those new to the game, this volatility can be unnerving, tempting them to make impulsive decisions based on fear or greed. One strategy that can help investors navigate these choppy waters is dollar cost averaging, a disciplined approach to investing that involves investing a fixed amount of money at regular intervals, regardless of market conditions. Think of it as setting your sails and riding out the storm, knowing that the consistency of your approach will ultimately lead you to calmer waters. By investing a set amount each month, regardless of whether the market is up or down, you essentially buy more shares when prices are low and fewer shares when prices are high, averaging out your cost basis over time. This approach can be particularly beneficial in volatile markets, as it removes the emotional element of investing, preventing you from making rash decisions based on short-term market fluctuations. Dollar cost averaging doesn't guarantee profits, nor does it protect you from losses in a declining market. However, it can be a valuable tool for investors seeking to reduce the impact of market volatility on their portfolios, allowing them to build positions gradually over time and potentially benefit from market downturns. Diversification, spreading the risk, maximizing returns. In the world of investment, the age-old adage, "Don't put all your eggs in one basket," rings truer than ever. Diversification, the practice of spreading your investments across different asset classes, sectors, and geographical regions, is a cornerstone of sound investment management, designed to mitigate risk and enhance potential returns. Imagine your investment portfolio as a fleet of ships, each sailing towards the same destination but navigating different routes and facing different challenges. By diversifying your holdings, you're essentially reducing the impact of any single ship encountering rough seas, ensuring that the overall fleet remains on course. Different asset classes such as stocks, bonds, real estate, and commodities tend to perform differently under various market conditions. For example, during periods of economic growth, stocks may outperform bonds, while during periods of inflation, real estate or commodities may provide a hedge against rising prices. By diversifying across these asset classes, you're essentially creating a portfolio that is less susceptible to the ups and downs of any single market sector, potentially smoothing out your returns over time and reducing your overall risk exposure. Section 4. Risk Management, Safeguarding Your Investment Portfolio. Investing by its very nature involves a degree of risk. No investment is entirely risk-free, and the potential for returns is often directly proportional to the level of risk assumed. However, prudent investors understand that risk management is not about avoiding risk altogether, but rather about understanding, mitigating, and managing risk within acceptable levels. Think of risk management as the safety net that protects you from falling too far, even if the investment tightrope you're walking on gets a little wobbly. It's about implementing strategies and safeguards to protect your investment portfolio from unforeseen events, market downturns, and the inherent volatility of the financial markets. Risk management encompasses a range of strategies, from diversifying your portfolio across different asset classes and sectors, to setting stop-loss orders to limit potential losses on individual investments. It also involves understanding your own risk tolerance, the level of potential losses you're comfortable with, and aligning your investment choices accordingly. Effective risk management requires ongoing monitoring and adjustment. As market conditions change, your financial situation evolves, and your investment goals may shift over time. By incorporating risk management principles into your investment strategy, you can aim to protect your hard-earned capital, minimize potential losses, and navigate the inevitable market fluctuations with greater confidence. Section 5. Seeking Expert Guidance, Navigating the Investment Maze. The world of investment can often feel like a labyrinthine maze, filled with complex financial instruments, ever-changing market conditions, and a seemingly endless stream of investment advice, often conflicting and overwhelming for even the most seasoned investors. In such a complex and dynamic environment, seeking the guidance of a qualified and experienced financial advisor can be invaluable, particularly for those new to investing or lacking the time or expertise to manage their investments effectively. Think of a financial advisor as your trusted guide through the investment maze, providing expert navigation, helping you avoid potential pitfalls, and keeping you on track to reach your financial destination. A financial advisor, acting as your fiduciary, is legally obligated to act in your best interests, providing personalized investment advice tailored to your specific financial situation, goals, and risk tolerance. They can help you develop a comprehensive financial plan, create a diversified investment portfolio, and navigate the complexities of tax-efficient investing. When choosing a financial advisor, it's essential to look for someone who is experienced, qualified, and trustworthy. Seek recommendations from trusted sources, review their credentials and track record, and ensure they have a clear understanding of your financial goals and investment philosophy. A good financial advisor can be an invaluable asset on your investment journey, providing guidance, support, and peace of mind as you navigate the complexities of the financial markets. Section 1. Finding your path. A balanced approach to investment. As we've journeyed through the intricate realms of stocks and cryptocurrencies, comparing their nuances, dissecting their potential, and acknowledging their inherent risks, one overarching theme emerges: the importance of a balanced and informed approach to investment. There's no one-size-fits-all answer, no magic formula to guarantee financial success. The ideal investment strategy is as individual as your fingerprints, shaped by your financial goals, risk appetite, and investment timeline. Stocks, with their historical track record, relative stability, and potential for long-term growth, remain a cornerstone of a well-diversified portfolio. They offer a stake in established companies, a share in their profits through dividends, and the potential for capital appreciation as businesses expand and innovate. Cryptocurrencies, on the other hand, represent a bold experiment in decentralized finance, promising faster transactions, lower fees, and greater accessibility to financial services. Their potential for explosive growth, fueled by technological innovation and increasing adoption, has captivated investors seeking to capitalize on the transformative potential of blockchain technology. However, their extreme volatility, regulatory uncertainty, and security risks demand a cautious approach and a thorough understanding of the underlying technology and market dynamics. The decision of whether to invest in stocks, cryptocurrencies, or a combination of both is ultimately a personal one, guided by your individual circumstances, financial goals, and risk tolerance. There's no right or wrong answer, only informed decisions based on careful research, a realistic assessment of your risk appetite, and a long-term perspective on investment. Section 2. Embracing the future of finance: informed decisions for a secure tomorrow. The financial landscape is in a constant state of flux, shaped by technological advancements, evolving regulations, and shifting investor sentiment. Navigating this dynamic environment requires adaptability, a willingness to embrace new ideas, and a commitment to continuous learning. The rise of cryptocurrencies, while introducing new risks and challenges, has also injected a much-needed dose of innovation into the financial system. Blockchain technology, the backbone of cryptocurrencies, has the potential to revolutionize various industries, from supply chain management and healthcare to voting systems and digital identity verification. As this technology matures and regulatory frameworks adapt, we can expect to see further integration of blockchain-based solutions into our daily lives, transforming the way we interact with data, conduct transactions, and manage our finances. The key to navigating this evolving landscape lies in staying informed, seeking out reliable sources of information, and approaching investment decisions with a healthy dose of skepticism. Don't be swayed by hype or get-rich-quick schemes. Instead, focus on understanding the fundamentals of investing, diversifying your portfolio, and managing risk within acceptable levels. Remember, Investment is a journey, not a destination. It's about making informed decisions today to secure your financial future tomorrow. By embracing a balanced approach, staying informed, and seeking expert guidance when needed, you can navigate the complexities of the financial markets with confidence and position yourself for long-term financial success.